So our final panel today is going to cover the future of Title III crowdfunding. Please welcome Vincent Bradley, who you've met earlier. He's CEO and co-founder of FlashFunders. Returning from a previous panel, the co-founder and CEO of Seed Invest, Ryan Feit. Joining us for the first time is Ron Miller, founder and CEO of StartEngine. And also returning from previous panel discussions, Mike Norman, president and co-founder of WeFunder. Welcome back, Mike. So this last panel is going to talk about exciting topics, regulation and policy and law. So we're going to make this fun. So I'm going to pick on Vincent to start with. So what is the Fixing Crowdfunding Act? This whole conference has been about the opportunity of Title III crowdfunding, but there's actually a bill in Congress that's being reviewed, I believe, literally today, about possibly changing it. So what is this act?
Yeah, so there's already been some fireworks backstage, and hopefully there'll be some fireworks on stage today talking about this, because we all have different viewing, different vantage points and different opinions on what's going to happen. But basically, in a nutshell, I think the industry and our elected officials have identified that there's aspects of the Jobs Act and regulation crowdfunding that we don't think are ideal. There's things that we think need to be improved, and so specifically, it has to do with the amount of capital a company can raise, financial disclosures, public reporting issues that can come into play later in the life of a company, and there's aspects that we think could be improved, and so several of us have reached out to our elected officials, and they're working on a bill to fix these, and it would then go to the SEC, and it would be implemented, and it would make, I think, this industry much healthier.
So Ryan, is this bill actually necessary?
Well, I think the rules are far from perfect right now, but there's enough already for us to get the industry started right now, and for people to start to invest in private companies, and for entrepreneurs to be starting to explore equity crowdfunding. So I don't think it's necessary for us to get started. I do think that a lot of the changes make a lot of sense, and a lot of us have been waiting 4 years for what's now kicked in a month ago. So I would say there's plenty to go ahead and get started now. Over time, as the industry proves itself out and we get more data, the rules will, I think, over time get better and better as we have more information. But I see no reason to sit back and wait right now.
Okay, so Mike, do you believe that if this bill passes, it will actually have much impact? I mean, Ryan's saying we're good to go, let's get going.
Yeah.
What do you think?
So let's dig into a little bit of what the meat of the bill actually says, right? So what we have right now at the legislation as it stands are kind of two real main issues that are affecting the companies that are deciding to use the exemption. So one is there's something called a special purpose vehicle, which you cannot currently use under crowdfunding. So when we helped write this law back in 2012, this was before the SPV structure had kind of become standard practice for Reg D deals. And the way it works is basically all of the investors that come into a deal are packaged into one LLC, and then that LLC invests into the underlying issuer. So that can't be done for regulation crowdfunding. What that means is that issuers wind up having kind of crowded cap tables in a sense, and concerns that follow on investors like VCs would get scared away from their deal because of these multitude of investors. Now, what that means is that in order for us to get good companies to use the exemption, which we've done a great job at, we have to put together contracts which are not ideal for investors. So there's a buyback provision right now which says that, okay, if you have an issue with raising follow-on financing from a VC, you can actually purchase the shares back from your crowdfund investors, such you can make sure that you have, your
so mandatory
financing.
Buyback.
Yep. Okay. So not mandatory, but it's at the discretion of the company.
Yeah.
Now the investors would still see a profit at the pre-money valuation, the increase between when they invested in the pre-money valuation of the follow-on round. But this is not the idea of I want to follow the company all the way through to potential IPO that we envision when we helped write the law back in 2012. So that's one of the things that actually was in the bill that made it through committee today, which is exciting. Now the other piece is this 12G exemption, which currently if you have over 500 non-accredited investors or 2,000 investors total and $25 million in assets, then you would wind up being a reporting company, which no company wants to do. It's expensive, it's pain.
So lots of paperwork with the SEC.
Lots of paperwork.
Huge compliance costs, legal costs.
Okay.
So if you're successful, you might have to pay a huge penalty.
Right, exactly. And so that's one of the things that is also being fixed in the Fixed Crowdfunding Act, which made it to committee today. So I think that solving both of those kind of core issues will make this much more attractive to some of the companies that have plenty of other financing options that really do have that vision of growing into huge, billion-dollar
And Richard, that's the key, because there is quality companies that are using this regulation. But if we talk to 10 right now, probably 8 are going to say no, because they have access to capital through other avenues, and it's low friction, and it's relatively cheap. Right now, because of these requirements, it's more restrictive. And so we're missing out on good deals, and that's frustrating. But you know what? The industry is alive, and it is moving forward, and I like the future.
I'm going to turn it around for a second. So is Title III crowdfunding going to be used by early stage companies looking for equity? Or is it going to be debt? Or is it going to be a vehicle for real estate? Because in Title II, it seemed like the real estate guys tried to come in and hijack a little bit. So is this about real estate, or is this all the above? I mean, who's going to be the beneficiary in terms of what sort of companies or what sort of deals are we going to be seeing?
Well, at this early stage, it's really dominated by companies that are essentially selling common stock is the most common way that companies are raising capital today. Now, that said, you'd think for a non-accredited investor, the idea of a convertible note is quite attractive, because obviously there's the income opportunity, plus, of course, the upside in the equity through the conversion of a capital event that would occur later on. So I do think that debt is attractive. I do think that debt will ultimately come online. However, today what we're seeing is largely companies that are selling common stock. Now, with regard to real estate, that's a different conversation, Richard. You know, I look at what happened, and StartEngine opted specifically not to launch under Title II because we didn't believe that Title II really was crowdfunding. In fact, we still see it today as largely the old Reg D hand-to-hand capital raise that just happens to be put through a platform instead of just a standard paper document as it was in the old days. Here, we're sort of opening the opportunity for what we think about as the other 92% of the population, which is the non-accredited portion. And because of that, I do think there's an opportunity in real estate. To be honest with you, it's something that I'd very much like to see. As an accredited investor, personally, I've been an investor in passive real estate. Mobile home parks, self-storage are the ones that I like the best. Why? Because I think they're low risk and they're cash flow producers. And wouldn't it be great if, and by the way, I average probably between 12 and 14% on average, right? Now, I get to do that because I'm an accredited investor, but why not open that opportunity for everybody? Everybody should get a chance, and so I'm real interested in those, and I'm real interested in those kind of low risk, what I call, just real basic, they just chug along. You never really get rich quick in a self-storage deal or a mobile home park deal, because they're not construction, they're not development, they're not going to be sold for a big pop, but rather they're long-term income that I think are offering the wealth building opportunity for people who have been cut out of the real estate ownership class.
And as we sit here today, I completely agree with you, and I think asset classes that are lower risk, that are going to cash flow, are going to make a lot of sense for this initially. And I think we're already starting to see that microbreweries that are going to be successful. I mean, if you look at the UK and the European market, tons of small businesses, brick and mortar, microbreweries,
absolutely
incredibly successful.
So let me ask you, Ryan, then I'm actually going to ask everybody, we'll start with Ryan. Yeah. So if you talk to venture capitalists, they're going to say, only the terrible lemons, adverse selection, bad companies are going to use this. I don't believe that, but I hear that a lot from the VC community. So talk about what type of companies are actually calling you? Who's picking up the phone, calling Seed Invest? Who's engaged with you?
Right. Well, look, at the end of the day, what matters for this industry is getting good companies to actually take advantage of Title III, period. Right. Getting good companies, that's what's going to matter, and that's what's going to make this sustainable. If you are a private company right now, an early stage startup, basically you do have options to raise capital from one institutional person potentially. Where Title III can be useful is if I'm an early stage capital, two of my biggest challenges are raising capital and getting the word out for what I'm doing. So the powerful thing about crowdfunding is that by getting hundreds or thousands of people that own a small piece of your company, you're building an army of brand ambassadors. And we've over the last 3 years, we've seen it time and time and again with companies we've funded on Seed Invest, where people are raising small amounts from accredited investors, and they're adding more value in a lot of cases than the VCs that we're investing alongside. So for Title III to really take off, and for us to get the best companies on the platform, we have to develop that. And so for the types of companies that we hear from and that we've worked with mostly, it's been consumer-facing companies that want to get the word out and want to invite their customers or potential customers to become owners.
So rapid fire, Mike, who are you hearing from? What type of company? Sector, geography, maturity stage,
it's
whatever?
Across the board. Two of our most successful companies, Hops and Grain, a brewery in Austin, raised $350,000 in about a week. We have another company, Beta Bionics, who actually closed a $5 million deal from Eli Lilly, one of the largest pharma companies in the world. I think they're a high valuation. So we've seen kind of both spectrums, these kind of like big long-term equity plays and these kind of local constituency-based debt plays. And I think it'll work for everyone, like Ryan said, folks that have something to gain by having a constituency of people that have invested, pounding the pavement, telling their stories, will all want to take advantage of it.
So I would say, Richard, that first off, on the StartEngine platform, we're seeing a very broad base of companies, both geographically, demographically, meaning the age of the founder and gender, as well as the type of industry they're in. So it's really across the board, even though we thought at the outset we would be focused on tech and media, because that's where we had started as an accelerator, but we're nowhere close to that, and actually I would say more in the transportation side, just by virtue of response to customers and not by design of the company. But that said, with regard to the future of crowdfunding, I do want to answer that question about the VCs because I have a very different view. At the end of the day, traction is everything. VCs will invest in companies that have traction, period. If they don't have traction, they're not interested. It's that simple, right? So if it's a crowd-funded company that has what they would call a messy cap table, we would call it a cap table with a lot of brand ambassadors, as Ryan was pointing out. But at the end of the day, they're good at structure, right? So they're going to figure out how to take these non-accredited investors who are holding common voting shares without the attendant rights that normally are accompanied in a VC-funded deal. And they're just going to come on top with preferred shares and all sorts of preemptive rights that will allow the VCs to protect their investors and still earn nice returns and use the crowdfunding vehicles as the way to validate the market proposition, the value prop, is going to get validated in front of the customer base, which is a unique aspect that we provide in the crowdfunding industry that they don't do as VCs.
Awesome. Vince?
Yeah, there's 2 points I want to make. Number one is the private capital markets are huge, and venture capitalism is a very, very, very small piece of it. And so when we look at all of the small businesses across America that need access to capital, there's actually very few that are venture backable. And so there's a ton that have family and friends as an option, SBA loans as an option, or they go to the bank and they do a traditional loan. And so this is now another great pathway for them to raise capital, and I don't think there's adverse selection there. I think this is an awesome pathway for them to raise capital, and we're seeing that. When we specifically look at venture, if I'm a venture backable business, I have VCs coming to me, I'm not using Reg CF today. I'm not using it because it's going to require a lot more friction, and it's going to cost a lot more money. Having said that, we are working with deals that have VCs coming at them, and they're so passionate about their customers and their community, they believe in it so much that they want to carve out a piece of their deal for their customers and doing Reg CF. So there are exceptions. I think for this to take off and for every good venture backable deal to say, I want to do a piece to my customers, we have to have some traction, which we're doing, and I think we need to improve the regulations a little bit to lower the friction and make these companies feel like I can do this and still be healthy moving forward, which I don't think all of them believe that at today's juncture.
So let's talk about that. What is it going to take, and this is a really broad question, and I'm going to ask all of you to opine here, for the general public to really become aware of and understand what Title III could mean for them? What do we need to do?
I've met with Indiegogo and Kickstarter, their CEOs and their management teams, and they're like 80% of people that come to our sites and back a company for the first time and buy a product still think they're getting a piece of ownership.
Wow.
So it's what NextGen is doing, and I think what all of us are trying to do is educate a generation on the fact that the securities laws have changed and you can now back these companies, and it's going to take time. But,
how long?
I've sat here, I've sat across the table from one of the biggest, best, most bad, can't use the word, investors in the world, and he said, I think this industry is going to be binary. I think there's going to be a big win, and I think the light bulb's going to go off for a lot of people, and there's going to be certain platforms where it starts to work at scale, and you know what, maybe he's right. We'll see.
Right?
all that matters is education right now, right? It's for 98% of Americans or whatever number you use, have never been able to invest in a private company before, and only 5% of accredited investors even invest in a private company. So the really important thing, and the thing that will get the space to the next level, is people understanding the risks of investing in private companies, understanding the opportunity, how it should fit into their overall portfolios, right? And having the general public think about this as an asset class. So that's what takes it to the next level. Go ahead.
Yeah, we're gonna.
Well, I would say a couple things. First is today, people are coming and looking at crowd-funded deals because they're passionate about the company and the product, and in some cases the founder. But first, it's the company and the product, and then secondly, they believe in the founder. It is not. If there's a misperception out there, and it's a misperception by issuers as well as I think industry observers, that somehow there's this pent-up demand by people who are just looking to get into investing across in startup and growth companies, and that's not it at all. What it is people are passionate about a particular company.
Right.
So, for example, in the case of Elio Motors, the Reg A Plus raise we did, these were 6,500 non-accredited investors. 96.2% were non-accredited investors. And those were people that were passionate about a $6,500 vehicle that they think is going to alter the course of transportation. That's why they invested, and they believe that founder, right? Now, what will get people even more excited is, just like in the Elio case, he decided to take it onto the OTC, and when he did so, the stock peaked at 75. It was sold on our platform, by the way, at 12.
Nice bump.
Peak, right? Yeah. And this was in, I think, the third week of February is when all that happened. Well, if you remember, the stock market had been, I think, a correction at that time, about a 10% correction. So if you had a broadly diversified portfolio, it went down by 10%. If you invested in Elio, this little startup company that was crowdfunded, you basically, even when the stock settled out, it's now trading at about 20 to 22. You bought it at 12. That's the kind of thing. Your question was, hey, what's it going to take? And my answer is, people are profiting, right, from good deals. They feel good about the companies they're in. They are acting as a brand ambassador, and they're getting that acknowledgement. And then the next step is that they're making money. I think that's, they'll be telling their friends. I'm sure the Elio people are telling their friends about, how smart they are.
So we're going to go down the line and get you at 30 seconds, crystal ball time. How many platforms do you think we'll have in a year? And what would be the total amount of investor commitments industry-wide 12 months from now?
Yeah, I guess I'm not as interested in how many platforms in total we're going to have at the end of the year. I think I would actually agree with the investor you mentioned, you were talking about earlier, where there's going to be a shakeout and there will be a few platforms that are actually seeing, the majority of the deal volume. So I'd say a year from now, maybe there's going to be 5 platforms total that are like relevant, and then maybe we're going to see $20 million a month in deal volume.
Okay, your prediction?
I think it's a 2 to 3 year shakeout. I think that shakeout will happen, but I think it's going to take longer than that. And if your question specifically is, so how many at the end of a year? I'd say roughly, probably between 15 and 20, something like that, will be attempting to operate. Now, I'm not saying that there will be much velocity on those, but I'd say operating FINRA-approved Reg CF platforms, probably between 15 and 25 would be my guess.
Well, the way I would think about it is that the UK has been basically doing equity crowdfunding for 4 to 5 years now. And if you look at a platform like Crowdcube, which I think has done the most volume in the UK, it really took them 4 to 5 years to get to a pretty interesting scale and break 100 million in annual volume. Last year, Crowdcube had 160 companies raise $120 million, so that's one platform. I'm assuming in the UK, you probably know the overall numbers, but I think it's going to be slower than people think. I think in a year or so, you might see that for the entire industry on a monthly basis, but we'll see.
But 150 million a month doesn't sound like failure to me.
No, they did $120 million a year last year.
Oh, I'm sorry, I missed
160 companies raised $120 million a year. So I think as you look out,
our economy is 10 times larger, so.
Yeah, but the reality is with large changes in securities laws, we saw the same thing with accredited investor platforms and peer-to-peer lending saw the same thing.
And our laws
takes longer than people think.
Our laws are so restrictive.
It takes longer than people think, and there's definitely huge drivers towards what we're all doing here, but it will take longer than people think.
Yeah. Well, we're going to almost out of time, but I want to thank all of you for your insights, and I think the key here is that whether it's 2 or 5 or 20 or 100 million or whatever the number is, you all touched on a really important point, which is the ability for innovative companies to connect with their customers, to receive financing, to mobilize bases. And we don't know if this is going to be like technology where we'll have 2 or 3 platforms, or whether we're going to see niches, or we're going to see dozens of companies. So it'll be fun to have you all back next year, and let's see where we are. Thank you, gentlemen.
Thank you.
Thank you.